Welcome to this explainer. Today, we're going to turn you into a full-blown financial detective by teaching you the actual language of business. Even the most seasoned investors frequently get duped by clever accounting and smooth-talking executives. Just think about the biggest corporate frauds in history. We're talking about massive empires that looked completely unstoppable on the outside, but were actually totally hollow on the inside. So today, we're moving way past the glossy marketing brochures and digging right into the raw data. We're going to decode the numbers so you can make smarter, purely data-driven decisions that actually protect and grow your money. Picture this. You're offered an exclusive chance to invest in a wildly hyped-up Legos beverage company. The marketing? Flawless. They've got flashy influencer partnerships all over your timeline, aggressive expansion plans in every major mall, and it literally looks like the products are flying off the shelves. But honestly, ask yourself, would you hand over your hard-earned money without knowing if they are secretly drowning in debt behind the scenes? Well, you shouldn't. Anyone can rent a billboard or pay for followers, but the true reality of a business simply isn't found in its social media engagement. Smart investors never, ever rely on hype or rumors. Think of it this way. A company's financial statements are exactly like a detailed medical report card. A good doctor doesn't just look at a patient's great tan and declare them perfectly healthy, right? No, they check their blood pressure, they run blood panels, and they look for underlying conditions. And similarly, smart investors use financial statements to diagnose the true internal health of a business. These documents reveal whether a company is organically thriving with strong fundamentals or if it has deep, hidden financial illnesses that the general public just can't see from the street level. Here's our roadmap for the explainer today. We'll be covering 1. The language of business. 2. The balance sheet snapshot. 3. The income statement scoreboard. 4. Why cash flow is king. And finally, 5. Spotting financial red flags. Let's kick things off with Section 1, the language of business, understanding the big 3. So before we can start solving any cases, we really need to understand how our core pieces of evidence fit together. Whether you're analyzing a traditional manufacturing firm in Accra or evaluating a decentralized crypto project operating out of Abuja, mastering these 3 interlocking statements gives you a massive advantage over retail investors who just trade on rumors. And remember, the big 3 don't just sit in isolation. They work together as a complete ecosystem. The balance sheet acts as the structural foundation. The income statement is the engine driving the valuation. And the cash flow statement, that's the raw fuel keeping that engine from seizing up. You absolutely have to look at all 3 to get the real story. Moving right along to Section 2, the balance sheet snapshot, a financial photograph. Let's examine our first core document, which basically freezes the business in a single moment in time. The foundational rule here is that assets must equal liabilities plus equity. But as financial detectives, we aren't just looking at the raw totals. We're interrogating the quality. We're looking out for toxic assets, maybe outdated inventory that will literally never sell, versus high-quality liquid assets. And on the flip side, we have to scrutinize the urgency of the liabilities. Is this long-term, low-interest debt, or is it aggressive, short-term obligations that could instantly crush the company's equity if the market suddenly takes a nosedive? It's all about the composition, not just the size. Let's look at a practical, real-world example of leverage using 2 merchants at Belogan Market. Trader A operates with 5 million naira in assets and 1 million in debt. Trader B has the exact same 5 million in assets, but carries 4.5 million in debt. Now, if a major supplier suddenly demands immediate payment, Trader A has the liquidity and the peace of mind to handle it. Trader B, however, is sweating bullets, operating right on the razor's edge of default. To a passerby, it's the exact same visible storefront, but it is an entirely different risk profile behind the scenes. You can never just admire the shiny assets a company holds. You really must investigate the leverage threatening to wipe them out.
Okay, Section 3, the income statement scoreboard, the movie of the business.
Unlike the static snapshot we just looked at, this next document is in motion. It tells the story of the company's performance over a specific quarter or year. We start right at the top line with total revenue, but the real detective work happens as we walk down the funnel. We subtract the cost of goods sold and operating expenses to arrive at the bottom line net profit. What we're hyper-focused on here is margin compression. A company can boast incredible headline-grabbing top-line growth, but if their raw material costs and operational bloat are growing even faster, that bottom line is going to be completely starved. Like they say, revenue is vanity, but profit is sanity. Which leads us perfectly into Section 4. Cash flow is king, the survival engine. Look, you can be highly profitable on paper and still go spectacularly bankrupt if your bank account actually runs dry. Consider Company A and Company B on this table. Company A reports $100 million in net profit, while Company B reports only $80 million. But when we look at the operating cash flow, Company A only generated $20 million, while Company B brought in a massive $120 million. How on earth does that happen? Well, Company A is likely booking revenue by selling aggressively on credit, inflating their accounts receivable while collecting very little actual money. Meanwhile, Company B is bringing in cold, hard, liquid cash. This document strips away all the accounting magic and shows you exactly what is genuinely funding the survival engine.
Finally, Section 5. Spotting financial red flags, doing the detective work.
So when a company's debt explodes from 100 to 300 in just 24 months, you are looking at a ticking time bomb. Now, strategic debt can certainly fuel aggressive expansion, for sure. But this velocity of borrowing destroys a company's interest coverage ratio. As that mountain of debt grows, the mandatory interest payments consume more and more of the operating profit. It creates a highly fragile ecosystem. If macroeconomic conditions shift even a little, or if sales growth stalls, they won't be able to service that massive debt load, and the entire corporate structure could face a rapid, catastrophic collapse. Another glaring distress signal? A clear trend of shrinking revenue across multiple consecutive years. Dropping from $500 million steadily down to $390 million indicates a fundamental loss of market share or product relevance. And what makes this so incredibly dangerous is that multi-year revenue declines often mask desperate, value-destroying management tactics. To stop the bleeding, executives might start aggressively slashing prices, gutting their R&D budgets, or sacrificing long-term brand equity just to make the current quarter look slightly less terrible. It's a structural warning sign you simply cannot afford to ignore. Ultimately, recognizing these red flags, from negative cash flows to ballooning unserviceable debt, is fundamentally about protecting your capital. Great investors don't just know how to pick the massive winners. They are absolute experts at not losing their principal on bad bets. Let's just do a quick mathematical reality check here. If you invest in a hyped-up, financially toxic company and lose 50% of your capital, you don't just need a 50% gain to recover. No, you have to make a 100% return on your remaining money just to get back to exactly where you started. Avoiding troubled companies is literally the cornerstone of wealth building. So, before you ever put your capital on the line, please run your prospective investments through this final, rigorous checklist. Just ask yourself, do I genuinely understand how this business model generates cash? Is the revenue consistently expanding? Is the enterprise actually profitable after all the expenses? Is the debt level safely manageable within their current cash flow? Is the operating cash flow positive and growing? And crucially, did I actually read the tiny, incredibly boring notes at the very bottom of the financial report? Because that, my friends, is exactly where management hides the bodies. If you can confidently answer yes to these, you are thinking like a true financial detective. At the end of the day, financial statements are your map through the noise. The numbers never lie, but people certainly do. So the next time you are tempted by an exciting rumor or you see a crowd chasing a flashy trend, just pause and ask yourself, are you reading the story the market desperately wants you to hear? Or are you reading the stark, unavoidable story the math is screaming at you? Protect your capital, trust the data, and let the fundamentals guide your decisions. Case closed.